welcome everyone here today. As you know, we're here to discuss Fannie Mae and Freddie Mac. And it frankly amazes me that we're having this conversation today. If you had told me 4 years ago that the future of the GSEs would remain as uncertain as it is today, I would never have believed you, but here we are. Many people believe that the GSEs were central to the crisis, or at least played a major role in upending the financial and housing markets. Nevertheless, the writers of Dodd-Frank, who had time to address a lot of issues that were completely unrelated to the crisis, did not even address GSEs. At the time that Dodd-Frank was signed into law, we were told that a plan for the GSEs would be forthcoming from the administration. And later than expected, in February 2011, there was a plan that came out. It was a 30-page skeletal plan, 4 pages of which were devoted to 3 different potential solutions. So the white paper insisted that the housing finance system must be reformed, and that we had allowed its flaws to go unchecked for too long. But now we're over a year later, and then just last week, HUD Secretary Sean Donovan testified at the Senate Banking Committee that the administration does not have a specific timetable nor legislation completed to submit to Congress. Congressional efforts at reform have not gotten very far either, and meanwhile the GSEs are continuing to solidify their dominance in housing finance. The lack of meaningful action on GSEs just continues a tradition of inaction that has allowed them to become the taxpayer albatrosses that they are today. Private market participants and government officials have demonstrated a remarkable inability to imagine a world without a taxpayer backstop for the mortgage market. I'm grateful to say that our panelists today have not only shown the ability to think beyond our serious addiction to taxpayer subsidization of the mortgage market, but have thought about practical steps that we need to take to break that addiction. I won't spend too much time introducing our panelists. All have impressive resumes and are prolific writers, so you're probably already familiar with their work. Briefly though, Arnold Kling is an affiliated senior scholar at the Mercatus Center. Dr. Kling has a PhD in economics from the Massachusetts Institute of Technology, and he's served in the trenches as an economist both at Freddie Mac and the Federal Reserve Board, and also has years of teaching experience. Anthony Sanders is a senior scholar at the Mercatus Center and the Distinguished Professor of Real Estate Finance at George Mason University. In addition to having served on faculties of a number of other universities, Dr. Sanders headed asset-backed and mortgage-backed securities research at Deutsche Bank. Dr. Sanders received his MA and PhD from the University of Georgia. Larry White is a member of the Financial Markets Working Group at Mercatus and has been, for over 3 decades, a professor of economics at New York University's Stern School of Business, where he is also deputy chair of the economics department. He served in the late 80s on the Federal Home Loan Bank board and received his PhD and BA in economics from Harvard and his master's from the London School of Economics.
My slide deck's like 40 slides, so I promise I will only go through about 3 of them. And I just went by the first one. Oops, previous. Very sensitive slides. Again, just to begin with, I just want to make one philosophical point. When we think of Fannie, Freddie, and the FHA, I like the analogy to a taxi cab medallion from New York City. Extremely expensive, $1 million, and our GSEs are the only ones that have the medallion, meaning it grants the government and taxpayer-backed insurance. Now the question is, how do you get a medallion? You have to cough something up. And what they've coughed up in the pack was affordable housing or mandates. So the question is, do we still want to have those? In a sense, it's an entitlement at this point. So we'll see if we really want to do this. The other point I want to make is that, you know, we can sit here and debate Fannie and Freddie's role in the crisis, but we really need to acknowledge that government policy has contributed quite heavily to this. If we, in fact, we go back to the Clinton administration with their national home ownership strategy and some other things that have occurred since then, they essentially took the safeties off the torpedoes. And so what's happened is it eventually just turned around and hit us, leaving us with 90% government control securitization markets. And if you throw in student loan capture, which the government now controls, and the reverse mortgage HECMs for seniors, which is now backed by the FHA. What I want to talk about today is my approach. My approach is I would dearly love just to get rid of the government guarantee, get government out of the housing market. On the other hand, what I want to caution against is the bottom point. We need to avoid creating a 100% FHA market. You get rid of the private sector and the guarantee, what happens if the private sector doesn't show up? We get 100% FHA. And my unfortunate feeling is that if we go to 100% FHA, we'll never get rid of it. And this is kind of the result of crowding out. There's Adam Levitin, who at Georgetown University says there's simply no such thing as a non-guaranteed housing finance market other than ideological fantasies. Well, that's not true. What I think I would say is that it's going to be very difficult going forward. We've obliterated the housing and housing finance system so badly with misguided policies that it's going to be a tough comeback, and it's going to take longer probably than some expect. The talking points are, and this is the ones that a number of my colleagues calling for government guarantees have all stated in the past. 30-year fixed-rate callable mortgages will not exist. That's false. Banks are still making 30-year callable fixed-rate mortgages. I'm not sure it's the best product, but they'll continue to make those. They argue that homeowners will have to take more risk. Good. I wish homeowners would take more risk. But risk also means that they have to suffer the downside if that happens, leading to likely putting more equity in a house and getting the contracts that actually help them match up the risk. Much larger, too-big-to-fail banking system will be needed with government support. Well, we already had too big to fail. We had Freddie and Fannie. So I just don't understand these general points they make. Now, here's the one that's the million-dollar question. Will interest rates be higher if we get rid of the government guarantee? And the answer is, of course, yes. Part of that reason is that the government has subsidized mortgage rates to the point where, again, they crowded out the private sector. And so it could be like 100 to 250 basis points higher, which is exactly where it was kind of back in the late Clinton era. And one of the other points they argue is that taxpayers' subsidization will lower interest rate volatility. Well, why should taxpayers be forced to pay for that? That doesn't make any sense. And again, my bigger picture is, the government, the Fed, have all combined to try to do things in the market, and I got to say, they've not worked very well. In fact, they've been kind of a disaster. Taxpayer bailouts will be more expensive. Well, we're already sitting in a big one. Now, here's our alternatives. A no securitization bank balance sheet lending world only. I would love it if that was true. Unfortunately, particularly after Dodd-Frank, we've made that almost a virtual impossibility. And again, it's a $10 trillion mortgage market, and the banks simply don't have the capacity, particularly in their highly regulated state, to expand. So what do we do if we just kind of evaporate 50% of the mortgage market? Well, you can imagine what would happen to housing prices. Again, securitization, again, held by three parties. Now, if we want to, again, have some sort of government involvement, what they probably have to do is go to some, what I call limited medallion approach. But rather than have everybody, or rather than three participations, we probably want to make this open to more than three. And that would require some sort of risk sharing between government and originators, in which in fact, this is partly Dodd-Frank. You have a bigger down payment, and then the first loss to originator would be increasingly higher, and then you have reinsurance on the backside. That's more of a catastrophic loss scenario. And Andy Davidson, who's sitting in here, has the cooperative structure, which actually has some advantages. And again, one of the problems with Freddie and Fannie, give my last little PR bit, it was always touted as the example of a great working private-public partnership. Well, we know now that didn't turn out so well. It means that it was the socialized cost and privatized gains. And taxpayers are now footing the bill on the downside. And the advantage of Andy's suggestion on cooperative structure, or you can actually do a mutual form of ownership, like insurance companies, is that it takes away the ability to have massive gains for people at Freddie and Fannie or their friends. And maybe we should just convert to a structure where that option is taken off the table. That might help. So my preferred solution is bank portfolio lending, securitization with no government guarantee, and no affordable housing mission. I think that would be the best, but we probably have to break ourselves into it. We're already in a very fragile point, and maybe this would be kind of bad time to do it. Second best solution, which is probably the most likely one, is some sort of partial medallion to all originators, risk sharing with the government. And again, I urge you caution. If we do this, we got to keep the government's insurance part very low as a true catastrophic loss. We already have the Fed standing in here to do this, but if we do this, we have to be aware of insurance creep, where after 2 years, they start saying, oh, can we have just a little bit more guarantee because no one's defaulting on their loans. I think we've been down that path, Andy, remember that? And so the third best solution, which is incredibly dangerous, is keep Freddie and Fannie in place, which is kind of what we're currently doing by not actually taking any action. But whatever it is, no retained portfolios, transparency, full transparency, and no affordable housing mandates. If we go back to 1991 when they passed the legislation giving affordable housing mandates to Freddie and Fannie, I would say that's one of the first things that have to go. Multifamily, I would argue you spin off Freddie and Fannie's multifamily units, such as the Fannie DUS program, but no insurance. Let the life insurance companies and the private sector take up that space. Besides, we already have HUD doing the same thing. How many of these programs do we need for affordable housing? It's probably going to require a 10-year phase-in, and my case on this is the same one I gave against Chris Mayer on his massive refinancing programs, like HARP Unlimited, is that anytime you undertake these massive policy changes, like the Clinton administration did, you end up with some unintended consequences that can be severe. And we just kind of went through that. We took all the safeties off the torpedo, it blew us up. Now we have to be careful not to blow it up again, to do something that is not actually going to work in the long run. I just have some graphs I'll show you. But again, here's I shouldn't have put the Great Leap Forward, I apologize. It was just in the back of my memory. But it just shows you when we go from 94 to peaking out at about 2005, and now we're down the downside again. So all the damage has been done by trying to increase home ownership. My advice, get rid of any home ownership targets. Leave them out. That's just a recipe for disaster. There's the home price history, which you're all familiar with. We're not really discussing the Federal Reserve here. But given the fact they were going through a gyration period, they lowered the Fed funds like a rock, then suddenly went, oops, we overheated the market, blew it up again. And look what happened. We leveled out and probably contributed to killing off the housing bubble. And now we can't restart it. Another issue I want to broach to you is that commercial bank holdings and mortgage-backed securities have kind of shot through the roof. There's a variety of reasons for that, preferred capital being one of them. So if we try to undo them, we have to be very careful how we undo this. They're really entrenched now. And here's just some data on the widening spreads that have occurred. So you can look at these at your leisure. But again, my summary point is that in my perfect world, just get rid of the guarantee. We don't really need, Freddie and Fannie can exist. They just can't have any guarantee, any lines to government, no housing mandates, and get rid of their retained portfolios. Let them be a securitization operation. Do we need two of them? Probably not. But I'll leave that to Arnold and Larry to figure out.
Okay, so I guess the main theme of what I have to say can be summarized as something that isn't directly housing finance, but it's equity buildup versus equity extraction. Until about 15 years ago, housing was a means for equity buildup, meaning that people in the middle class would purchase a house and start out with some equity in the house and then build up equity over time through home price appreciation and through gradual principal pay down of the mortgage. But somewhere along the way, around 15 years ago, and sort of at an accelerating rate, we went from equity buildup to equity extraction. So it became customary to put less than 5% down payments, so you start out with very little equity, and then you had cash out refinances to extract equity, you had home equity lending to extract equity. So to me, that's the sort of the worst part of the way the housing finance market evolved, is that it evolved away from equity buildup to equity extraction. And once it did that, I think the sort of the tragic consequences were sort of inevitable. In terms of Freddie and Fannie's role, in some sense in the housing market, they were part of the solution back in the 80s when the savings and loan industry was collapsing. They became part of the problem, especially in 2004, 2007, when just as other people like AIG were backing out of the riskiest, supporting the riskiest practices, that's when Freddie Mac and Fannie Mae decided to dive in, and they found ways, in spite of what I thought of as their charter, to lend at very low down payments and to risky borrowers. So solutions going forward for housing finance, in the paper that I put into the Mercatus compendium, I don't know if that's been handed out or if it's not, it's readily available. I call one solution the devil you know approach, which is really to go back to Freddie Mac and Fannie Mae as they were, with one major change, which is that they would be regulated by the Treasury. And we had this ironic situation that we had in housing, we had consumer protection under the Fed, and we had safety and soundness regulation under HUD. And if you just reversed those, you would have had a more appropriate regulatory structure, and you might have avoided a lot of the problems. That is, the HUD presumably had more of a institutional interest in consumer protection, and the Fed, or let's say Treasury, had more of an interest in safety and soundness. So that one little organizational misfit might have caused the whole crisis in some sense. So that's the devil you know approach. Then if the other approach is the one that I think Anthony was preferring, which is just to say, all right, let's not put any government support into securitization at all, which I think would mean that securitization would die and mortgage lending would go back to the originate to hold model, where you don't have the conflict of interest between the originator and the holder of the mortgage. You don't have, when a bank is originating a loan, it doesn't have an incentive to to make a risky loan and try to pass it off to itself. There's not that conflict. There are also less conflicts involved in servicing loans. The bank is the one investor with the interest in a loan. You don't have different investors with maybe conflicting interests, so it's easier when a loan is troubled to come up with a sensible decision about whether to give forbearance or not. So I think the originate to hold model would be it is a reasonable idea to go back to. But I have to say that the real key in housing finance, in my view, isn't so much the structure of the housing finance system. It's to get away from equity extraction and get back to equity buildup. And so one way to do that is to, regardless of what kind of structure you put in place, to make sure that there's no government subsidies for cash-out refis, no government subsidies for home equity loans, and in my view, there should be no government subsidies for low down payment lending, and that would mean, of course, changing the way FHA operates. Perhaps to have FHA give some kind of, matching grants for down payments to try to help people get through the first few years of mortgage payments, or some kind of voucher system rather than having just a low down payment mortgage program. What do I have in terms of time?
You got 5 more minutes.
Oh, that's too bad for you. Okay, I think on a sort of pessimistic and cynical note, I'll say that regardless of what I say, what other economists say, and whether their point of view of economists, they're coming from a libertarian point of view, a conservative point of view, a progressive point of view, there's an 800-pound gorilla in housing finance, and that's the lobbying that takes place by the realtors, the mortgage bankers, the home builders, Wall Street, and actually back in the day when Freddie and Fannie were flourishing, it was a 2-ton gorilla because they were part of it. But this 800-pound gorilla is just, you're not going to, it explains a lot about why housing policy is what it is. And so the actual day-to-day task of a policymaker isn't so much to come up with the theoretically best structure for housing policy, it's to come up with something that they can kind of get past this 800-pound gorilla to implement. And the 800-pound gorilla, of course, wants nothing but subsidized mortgages, lenient mortgages, and all the rest. And so it's a difficult challenge. My final comment, what I say about getting from here to there, people talk about that as a challenge. And my line on that is sort of, what would Reagan do? Because when he assumed the presidency, the assumption was the last thing you could do was decontrol oil and gas prices. That it would cause a disaster if you took the controls off, the energy price controls, which we'd been living with for several years. And of course, the first thing he did was get rid of those controls. And so somebody with that kind of spirit needs to come into housing policy and sort of do the unthinkable, kind of rip the Band-Aid off, take whatever happens in terms of short-term pain in the housing market and get back to a housing market where there are genuine prices. It's not rigged against people who are buying houses, which is the way, if you end up trying to prop up house prices, you're really rigging the market against buyers. And some of them sense that, and that's some of the hesitation in the market comes from that. So if you get away from a rigged market and you have natural buyers and sellers, natural prices, I think things will end up better.
I'm Larry White, and I'm very pleased to be here this afternoon. Now, something that Hester didn't tell you, and this has to be full disclosure. As part of my position in the federal government in the late 1980s as one of the board members of the Federal Home Loan Bank Board, I was also one of the board members of Freddie Mac. That was simply part of the governmental responsibility at the time. Very different organization at that time, but regardless, when I left government service in August of 1989, I also left the board of Freddie Mac. Since then, in 1994, I was asked by Freddie to write an article about stress tests. I did so. They paid me $5,000. It was published in a publication of Freddie Mac at the time, Secondary Mortgage Markets. And in 2004, Fannie Mae asked me to come down to Washington, up to Wisconsin Avenue, to talk to their advisory board about bank capital requirements. I did so. They paid me $2,000. I flew coach class both ways. I took street hail taxi cabs to and from the airports. So in the current climate, That's full disclosure. All right. Now, when you're third in a group like this, you always have to worry, have they taken all the good lines? Is there going to be nothing left for me? Well, they've done some good lines, but fortunately, there are a few things left for me. And I've got to start with this quotation from David Frum. The shapers of the American mortgage finance system hope to achieve the security of government ownership, the integrity of local banking, and the ingenuity of Wall Street. Instead, they got the ingenuity of government, the security of local banking, and the integrity of Wall Street. As many of you know, David Frum was a speechwriter in the early part of the Bush II administration. He was, I believe still is, a columnist for the National Post, which is a Canadian national newspaper published in Toronto. You can see why he is a speechwriter, columnist, and I'm a mere academic. Then there's Rick Carnell testifying in front of the Senate Banking Committee. The GSEs play an extraordinarily successful double game, telling Congress and the news media, don't worry, the government is not on the hook. And then turn around and tell Wall Street, don't worry, the government really is on the hook. And of course, he was right. Rick was an assistant secretary in the Treasury for financial institutions during the late Clinton administration and is now a law professor at Fordham University. Then there's the ever relevant quote from Warren Buffett. It's only when the tide goes out that you learn who's been swimming naked, and alas, we've learned all too much about who is swimming naked for way too long. And then finally, and this is a Washington quote, of course, from the movie All the President's Men. I can't remember if it was in the book as well. Follow the money. And certainly that's always a relevant piece of instruction, as both Tony and Arnold just indicated. All right, I'm a business school professor, so I have to tell you what I'm going to say, then I have to say it, then I have to tell you what I said. So I'm going to talk about housing and subsidies, I'll talk about Fannie and Freddie, bailouts, you see the full list there. So just to remind you, housing is heavily subsidized. I mean, in some sense, that's a duh statement, but I gotta remind you. And it's not only Fannie and Freddie, but as both Tony and Arnold indicated, it's FHA, et cetera. There are the income tax deductions for mortgage interest, state and local government taxes, although if you're in high income bracket, the state and local government taxes go away because the AMT eliminates those. There's the capital gains exclusion, there's subsidies for builders, there's subsidies for renters, there's direct provision, and I probably left off half a dozen things that John Weicker could probably fill in here. Now, what is the consequences of heavy subsidy? Well, again, for an economist, duh. People buy more house. They buy a house with a 5th bedroom rather than just 4, with a 4th bathroom rather than just 3, on a 1/3 of an acre rather than just a 1/4 of an acre. My former colleague at Princeton University back in the day, Ed Mills, doing some what I thought was very good work, and it's been supported since then, estimated, and this is back in the early 80s, that the U.S. housing stock, because of all those subsidies, was 30% larger than it otherwise would have been. And as a consequence of too much investment in housing, which at the margin wasn't as worthwhile as investments in other things at the margin would have been, and whether you think those other things are more investment in private sector business capital, factories, land, equipment, inventories, whatever, or you think it is more investment in social infrastructure, roads, airports, hospitals, schools, or you think it's more investment in human capital, more and better education, whatever it is, because of the diminished investment in those other areas, U.S. GDP, Mills estimated 10% lower. I I mean, imagine, that's in today's economy, that's $1.5 trillion. I mean, we would kill for an extra $1.5 trillion of extra GDP, but we don't. We fritter it away. Now, further, if you're interested in income distribution issues, where do those subsidies mostly go? They mostly go to upper income households. They're the ones who itemize, they're the ones who have higher marginal tax rates, and so the deduction is worthwhile. What do we get for this? Well, we mostly just get more house. We don't get a significant increase in home ownership, which is the story that underlies a lot of the subsidy. You look at any international ranking, and the United States is basically in the middle or maybe even lower middle of home ownership rates internationally. We're not where we probably think we are up at the top. We're not there. But, you know, what we get? We get more house. And where is the social benefit in that? Now, just to remind you what it is that did Fannie and Freddie in. First, it was taking on too much risk, starting in the late 1990s, but big time in the middle of this past decade, and they didn't have enough capital. It's okay to take on risk if you have enough capital. What's capital? Net worth. It's the buffer to protect a company against unexpected losses. If you have enough capital, that's great. That's fine. Take the risk. But they didn't. And you can see by statute, 1992 Act, they only had to hold 2.5% capital against mortgages that they held in their portfolio, and only had to have less than half of 1% of the value of a mortgage that they were guaranteeing. They were taking on all the credit risk of mortgages that they guaranteed, and they only had 0.45% capital. In contrast, depository institutions have to hold 4% capital just to cover that same credit risk, and so small wonder that Fannie and Freddie were expanding in the 90s and in the first decade of the 21st century at the expense of depositories. Look at those advantages, as well as they're having a borrowing advantage because the financial markets recognized they were GSEs. If push came to shove, it was highly likely the Treasury would come to their rescue, as turned out to be the case, and thus far the Treasury investment has been $180 billion and counting. All right, how do we avoid this in the future? First and foremost, more capital. More capital for anybody who is big enough to be systemically important. SIFIs in the language of Dodd-Frank. If you think that size is a problem, what's the right, and what do I mean by problem? In economist lingo, a negative externality, a negative spillover effect. What's the first thing we teach students in undergraduate Economics 101? If there are externalities, the best way to deal with them, put a tax on them. And so if you think size is a problem, put a tax on size. That was one of the early ideas of the Obama administration in the spring of 2009. Perfectly good idea. Unfortunately, they sold it or tried to sell it very badly, and the idea went nowhere. Much better than, and I don't know if you want the metaphor of a sledgehammer or a meat axe to try to break up large institutions. Put a tax. Let them decide, is it worthwhile to stay in business being this large, having to pay the tax or not? Cut back on government guarantees, limit the guarantees just to the FHA world, and we need to be clear-eyed as to why they are there or would be there, which is to help first-time, low, moderate-income households, properly screened because home ownership is not for everyone, to become first-time home buyers. Because it would be a subsidy, we should expect moderate, budget for it, moderate losses. And this is echoing something that Arnold said a few minutes ago, eventually replace the mortgage subsidy with a down payment assistance. What does mortgage subsidies do? It just encourages excessive leverage, the kind of cash out stuff that Arnold was talking about. Now, here I have a little bit of shameless self-promotion. I and three colleagues at the Stern School of Business wrote this book. It came out about a year ago. All royalties go to Stern, none go to us. The list price by Princeton University Press is $25. If you go on Amazon, they'll sell it to you for $16 and some change. Buy two, and they'll ship it to you for no shipping cost. So buy one for yourself and send one to your Uncle Harry or your Aunt Sally or to a niece or a nephew. All right, end of self-promotion. How to avoid bailouts of the, how did that happen? Okay. What about affordability and accessibility? Those words have come up before. They come up every time there's a proposal for what to do about housing finance in the future. Those lobbying groups that Arnold talked about a few minutes ago will bring up the words affordability and accessibility. And I'm an economist. I think about markets, supply, demand, equilibrium prices, and I was trying to integrate what does this affordability stuff mean? What does this accessibility stuff? And I finally realized what they're really affordability. It's a code word for widespread subsidy. That's really what they're talking about. And so you see the word affordability. You're seeing an argument for or a plea for widespread subsidy. In terms of affordability, let me remind you, prior to 2007, when everything came apart, the basic differential between conforming loans, Fannie and Freddie loans, loans that were qualified to be bought by Fannie and Freddie, and jumbo loans was 25 basis points, a quarter of a percentage point. That was it. Academic study after academic study basically showed that. Now, maybe in the post-2008 world, maybe that's a bigger number. Maybe even 50 basis points. I'm not as pessimistic as Tony, who said it might be 100 basis points. I don't think so. So 50, a half of a percentage point. If that's what we're talking about, is it worth going through all the hoops as a consequence? What about accessibility? I finally realized that's a code word for mandates. And you have to then ask the question, why are mandates needed? If it's already a profitable activity, what's the point of a mandate? If it's not profitable, then you have to ask, so why are we mandating it? And as I would suspect, it's really concerns about discrimination, then let's address that directly and prosecute vigorously. I think that's the best way to be dealing with that. All right, what about the 30-year fixed-rate mortgage? Again, as Tony mentioned, there are jumbos out there that are 30-year fixed rate. They've been made by banks. They will continue to be made by banks. I don't think the 30-year is what is at stake here. Further, if we're talking about government guarantees, the guarantee is for credit risk. It's not for interest rate risk, but interest rate risk is what the 30-year is all about. And so there's that disconnect here. Further, I think it's, who's going to buy 30-year mortgages? Well, there's a group of just natural buyers, which are insurance companies, especially life insurance companies, and pension funds, because they've got these long-lived obligations, and it would be natural to match their long-lived obligations with long-lived assets. But the standard mortgage in the American context carries this prepayment option, and my reading of the insurance industry is they just don't want to have to deal with prepayments. And so I think any long-run solution has to have an appropriate prepayment fee. Notice I'm not using that word, the P word, penalty, because that's pejorative. That already gets people thinking, oh, how could we ask people to pay penalties? No, this is a fee. This is a fee for the option. You want to exercise the option, you pay the fee. You don't exercise the option, fine, there's no fee. And Dwight Jaffe has estimated that mortgages carry a 50 basis points, a half percentage point extra interest rate because of the embedded option that isn't paid for at the time of exercise, but is simply there as a free option. All right, where will the mortgage finance come from? Well, I'm a little more optimistic than Tony. I think there will be some expansion of depositories. After all, even back in 2007, when Fannie and Freddie had all these advantages, depositories found it worthwhile to hold 30% of the outstanding mortgages, and get away from a world where there are these specially favored entities. And I think at the margin, depositories would expand their activity. I think we would see, and here again I differ with Arnold, I think there would be room for securitization. It would be much simpler. It would be some relatively simple senior subordinated type structures. And again, pension funds and insurance companies, natural buyers. Look, there's $17 trillion of assets out there, and at the moment, less than 6% of those assets are invested in mortgage-backed securities. So they're just a natural fit here. All right, how do we get from here to there? At the moment, as both Tony and Arnold reminded you, over 90% of originations are ending up being funneled either through Fannie, Freddie, or FHA. Does that mean that the private sector doesn't want to do this stuff? No, all it means is the private sector is being crowded out. It's hard to compete with government. We knew that even in the Fannie Freddie world. If you look at the record back in the 1990s and up till 2007, the private sector had been basically crowded out of conforming loans. Why? Because Fannie Freddie had all those advantages. All right, so how do we get from here to there? We start winding down the portfolios. We start cutting back on conforming loan limits by 10% a year. Do the same thing for FHA so that it again becomes something for low, moderate income households. And again, ideally, we ought to be replacing the mortgage subsidy with down payment assistance and raise Fannie and Freddie's guarantee fees by 5 basis points a year. Other needed long-run reforms, let's cut back on housing subsidies more generally so that we can get away from that too much house and not enough of other things. As I said, replace the lending subsidies with down payment assistance for low, moderate income households, make renting respectable. If you really want to do something about the cost of housing, focus on things that make housing artificially high cost, things like local land use zoning, and that would be especially relevant for encouraging more rental housing. And I mean, it just boggles one's mind to realize there are still limitations on imports of lumber coming in from Canada. What do limitations on supply do? They cause prices to be higher than would otherwise be the case. Until 2009, there were limitations on cement coming in from Mexico. Make recourse the norm. Most states do allow recourse, but the culture is such that lenders don't go after mortgage borrowers who have defaulted. Somehow change that culture so that recourse is considered normal. Other countries have recourse. It seems to work well for them. It'll discourage the strategic defaults and discourage excessive leveraging. And then, and this would relate to Arnold's point about the excessive leveraging and the cash out financing, give the primary lender the ability to have, has to give its permission if the borrower wants to take out a second lien, wants to take out a home equity financing. Because that, as we've learned, that second lien, until there's a foreclosure, where then it really is behind the first lender, up to that point, that second lien holder has all kinds of strategic behavior open to it that makes things like loan modifications much harder, as well as just this whole excessive leveraging. The ability of the senior lender to have to have its approval for any further lending by the borrower is absolutely standard in commercial lending arrangements. I'm not going so extreme. You know, the household could still do credit card debt and still do auto loans and boat loans and whatever, but in terms of the house and the mortgage, let the senior lender have that kind of approval power. So, in conclusion, as you know, housing and housing finance are important. Good policies really can make a big difference. As we've learned over these past few decades, unfortunately, so can bad policies. And if we're going to get good policies, sooner is better than later. Thank you very much for this.